Jeff and I fall into the millennial category, so we're all about videos. Videos are a great way to teach people about certain things like renting versus buying. So I'm going to jump to, Scott teed this up perfectly for me. He started talking about the three things that worry millennials the most in terms of who we're talking to, or how we talk to them about this conversation. So before I get into a bunch of interesting data and trends on this, give me an idea, when you think of a first-time buyer, somebody who you have to convert from a renter to a buyer, give me an idea of who that person is, demographically, behaviorally, just who comes to mind, who pops to mind right away? Anybody? Shout it out. Young? All right. What else? Older? Somebody renting? All right. Anything else? Somebody in their first job. Okay. Perfect. So we've already hit home a little bit on the millennials piece, but I'm just going to share some interesting tidbits with you. So this is more looking at this from a macro perspective. So the U.S. labor force, over the last 20 years, you can see that the millennials have actually surpassed the Gen Xers and the boomers, which tells you purely from the economy standpoint in terms of who's driving income, who's driving wage growth, and ultimately who's going to be driving the housing market over the next decade or two. Look at the graph. That's going to tell you who you need to be targeting and who we need to understand a little bit better. So younger renters plan to buy. So this is pretty obvious that, if there was a poll done, this is from the Fannie Mae housing survey last year that looked at folks who are currently renting, how likely they are to buy. And what's interesting about this data is, your 18 to 34s, those are your millennials, 9 out of 10 at some point want to buy. So there is this desire to buy. It's not that they don't want to, it's just that they feel that they can't. And so once again, we need, as professionals, to bridge that gap between the can't-do attitude and the fact that there are options out there for them to be able to buy more. So there's this idea that millennials have a lack of financial security. They're worried about affordability. We've already hit on the student loan piece. There was actually a survey that was or a study that was recently published, I think it was 2 weeks ago, by NAR and a nonprofit consumer literacy program that said 71% of millennials said that student debt was keeping them from buying a house. So 3 out of 4 said student loan debt is keeping them from buying a house. 80% said that student loan debt is keeping them from saving for a down payment. So this idea that they just feel like, a lot of them came out of college right after the recession, had a hard time finding a job and finding a job with consistent income. They feel like job stability maybe isn't quite as strong as it could be. The idea of later household formation. So millennials aren't getting married as soon as others. They're not going out on their own. A lot of them are coming back after school and living with parents, which actually presents an interesting dynamic and challenge for the housing market, because you have all these millennials who don't think that they can buy, so they're stuck at home living with mom and dad. But the problem is mom and dad can't downsize because you got all the kids at home right after school. So what does that mean from an inventory standpoint? You don't have as much inventory because the homes aren't coming on because everybody's living at home. What happens when you don't have as much inventory? The prices go up, which in turn makes it harder for our millennials to buy. So it's kind of this cyclical trend of in terms of the. Did somebody have something to say? Yeah, exactly, kick them out right away. Different priorities, we hinted on that a little bit, the idea that this generation is all about traveling, they're about spending time with friends, they're not about putting their roots in the ground in terms of making a house buying decision. They're looking for urbanized apartments that have all these amenities that if they were to try and take that and mirror it to a buy decision in an expensive condo, it's difficult because they're not going to get all the fancy schmancy stuff that they might have in their apartment situation. And the do-it-yourself mentality, this idea that information is at your fingertips at all times. There was a statistic that 51% of millennials found the home that they purchased online. So that means that 1 in 2, they didn't even have to, they went to the house eventually, but they found the exact home that they wanted to buy online. So all right, so we talked about, so in terms of first-time buyers, so this is from the NAR Generational Trends Report. NAR has been doing this report since 2013. It's a 140-page report. Here's the good news, is I read it all for you, and I consolidated 140 pages into 2 pages. I read the entire report. So here's the information that I pulled out of it that I think is most important when we think about converting renters to buyers and then how you as real estate professionals come into that conversation. So first off, why the heck are we targeting millennials? Why do we talk so much about this generation? Well, the bottom line is almost 7 out of 10 first-time buyers come from this generation. So more than likely the folks you're going to be dealing with fit right there. 1 decade. So what was interesting from the survey, and the survey went out to, I think it was about 98,000 respondents. So it's a pretty big survey. It's nothing small. Most millennials expect to live in their house for a median of 10 years. Who thought that was the case? Not many, exactly. Only 5% indicated 3 years or less. So what that tells us is that when these people make a homeownership decision, when they decide to buy, they're saying, all right, we are ready to stick our roots in the ground. We're ready to move in. And what's great about this is that when we get to more of the formal rent versus buy analysis a little bit later, the amount, as I hope you guys know this, the amount of time that you spend in the house is a huge impact on the economic drivers around whether it makes sense to buy or rent. So when you have people like this who are willing to say, okay, we're going to buy and we're going to stay there for a while, it makes sense. 89% of millennials purchase their home through a real estate agent, which is the highest of any category. Does anybody find that surprising? You would think the do-it-yourself mindset, I can do this on my own, I don't need a real estate agent to do this. 9 out of 10 bought through a real estate agent. And this is probably one of the most validating statistics in terms of what Jeff was talking about when it comes to education, in that 71% of millennial buyers said the number one reason they used a realtor was to help educate them about the purchase process. That's what they're looking for. They're not necessarily looking for you to negotiate the best sales price for them, to give them the best deal, to drive the best car, whatever, you know, the other qualitative stuff or quantitative stuff. They're looking for somebody who can educate them about the process and the financial decision making that you need to make around that process. 84% said that owning a home is a good financial investment, and you have to think of that in the context of most of these people probably had a parent or a friend or a relative or a neighbor who went through a short sale or foreclosure and saw firsthand that buying a home wasn't necessarily a good financial investment for some. So the fact that we're not that far away from 6, 7, 8 years ago when all that was happening, and yet this survey that was just done last year and published this year, they're saying that 8 to 9 out of 10 in this generation still believe that ultimately buying a home is a good financial investment. Getting back to some of the real estate trends, fewer looked online for properties as a first step, which I know is hard to believe. I honestly disagreed with that, but I was like, well, it's from a survey. But more looked online about the buying process and reached out to an agent. So what they're doing, once again, it's this education piece. And the part about looking online to reach out to an agent, I won't talk about reviews because that's a whole nother seminar on just reviews and the importance of having those public and readily available to your clients. But this generation cares about what other people think about you, period. And what's the best way to see that? Is to give them that information and make it as public as possible. So I know Avery-Hess has done a lot with reviews, testimonial tree. That stuff for this generation.
Commercial there?
It is. I mean, for this generation, that's extremely important. 97% finance their home purchase. So these folks, we've already talked about, they don't have a lot of cash. They need to finance. So they need to understand the financing process, how the mortgage process works. And then lastly, just more to summarize, is convenience to a job and affordability were the most important factors in terms of house location. So just getting back to the idea of affordability, needing to understand that this is a good financial decision for them is pretty darn important. So a little bit of information about our DC market. I won't spend too much time here, but NAR recently said that top 10 best purchase market for aspiring millennial home buyers, literally as of this month, is right here. We are one of the top 10 in the country. And if we put it in perspective in terms of the income piece, so median income of a millennial in DC metro area is about $70,000. So let's take $70,000 in annual income. Let's factor in student loan debt, car debt. $70,000 is roughly $6,000 a month in income. Remember that we typically qualify for at 45% of your income. So if you're making $6,000, we'll allow them to take up to, and with some exceptions, up to 45% of that monthly income. So if $2,700 is the maximum that they can qualify for, and let's say they have a $300 car loan and they have $400 in student loan debt, that still means that at the end of the day, they have $2,000 or $18,000 or $19,000 or whatever to allocate towards housing. I'm sure most people in this room can find a affordable housing situation for a potential buyer with a payment somewhere around $1,800, $1,900, $2,000 a month. I know, and a lot of people look at it, they're like, gosh, $70,000 in income, how the heck are they going to make a $2,000 payment? I'll share my own story because I'm a millennial. The first house that I bought was a townhouse, and I was of the, hey, I'm still in college. I still remember the whole idea of having roommates, and so I'm willing to have a roommate. And my roommate paid more than half of my mortgage payment for me for the first 4 years that I owned a home. I got that. I understood that at the end of the day, this is a good financial investment in the long term. Still own that house today, 8 years later. So, yes, I did declare the rent. Never hide that information from our friends at the IRS. There was an interesting stat that, just getting back to the affordability piece, that for a two-bedroom apartment, and granted this is Washington, D.C., but for a two-bedroom apartment in Washington, D.C., average rent's about $2,800, which means that as a household, you need to make almost $119,000 a year to afford that two-bedroom apartment, which is just crazy. So once again, rent prices aren't getting any lower, and it's certainly, from an affordability standpoint, is getting cheaper here in this area to buy. So starting the conversation, before I jump into this, so let's summarize. So we've talked about the issue with millennials, challenges with millennials around our student loan debt. We've talked about issues with down payment. We've talked about this idea that they're worried about affordability. They're worried about understanding the home buying process in terms of whether it makes sense and it's a good financial decision for them to make. And yet they have this do-it-yourself mentality, but they're still looking to us to get information about whether this makes sense. So when we work through, in a few minutes, we're going to work through some of the methodology. And the reality is these buyers, these renters, are looking to us for that information. And we need to be able to start the conversation and communicate on their terms. So I know for a fact in the millennial world, text is already replacing talk. More and more millennials want to communicate by text. They don't want to answer the phone. They don't want to talk to you for 20 minutes and get the feel-good story. They just want to get the information and the details quickly and efficiently. I know a number of agents in this office that use text a lot, whether it's me or their clients, and that's a good thing. That's how we like to communicate. From an impactful standpoint, there was a stat that said text message open rates exceed 99%, and 90% of all text messages are read within 3 minutes. How many of your emails do you think get opened 99% of the time? And how many of your emails get opened 90% of the time within 3 minutes? Very few. So purely from email is dying. So with this generation, if you're not joining the smartphone and the text world and communicating with them that way, it's going to be a struggle. Well, before I get into social media, I'll share a quick story. I had a client that got my information on through Zillow, and they saw my reviews on Zillow, and so they connected with me last year, and they called me, and I had about a 5-minute conversation. I went through, okay, here's the steps of what we need to do to get the process starting from a financing standpoint, and that was sometime last spring. And so I got all their information, and we just communicated email, text, and a year later they finally bought their house. And this is rare, but literally from day one of the loan process till the end, that the only conversation I had with them was that one 5-minute conversation. And after they bought the house, they had some money in the bank, so they put 20% down, and they said, we'd like to do some renovations on the house. Can we go get a home equity loan or whatever? I said, sure. So I put them in touch with my contact at Cardinal. And in that world, you have to go into the bank and sign your loan document. So you walk in, and Elena, who's my contact at the courthouse branch in Arlington, after they saw the doc, she calls me and she goes, Brian and Lehigh, they had such good things to say about you, and they had never met you. And they were like, how in the world is that possible? And I was like, welcome to our generation. This is the way it works. That you can build that trust, and you can communicate on their terms and still make it work effectively. Doesn't mean every client's like that, but certainly a lot of these are. Social media is the new word of mouth in terms of referral marketing. So if you're not joining in with the Facebook and the Tumblrs and the Instagram, you're certainly missing out there. They're looking for value-added links and videos. Now, I'm not sure if our videos today provided a lot of value add, more entertainment add, but they're looking for information that's dynamic. They understand that we operate in a changing economy and market, and they want that information, not necessarily stagnant mailers. I know personally, if I could just get rid of mail, I would. but the United States Postal Service has their thing going on there. Considering a different approach to engagement. So this idea around that, the days of come to the office, meet them at a property. These people want to engage with you in a situation that isn't so salesy and pressury to do something. And the fact of the matter is if you take them to, let's say, your approach is, oh, you're interested in buying a house for $300,000 in, wherever in Stafford. Well, let's go to 3 different properties that that I think would work for you. What happens if they go into that property the first time around and there's new carpet, old carpet needs new kitchen, there's problems with the house? It's going to scare the living daylights out of them, and they're not going to understand that at the end of the day, this is more about making a good financial decision and sitting down with them to do that, less about thinking property specific, sitting in your office. So take them to a restaurant, take them to a coffee shop, take them to a bar. Some of my best clients that I have, who I do have interactions with on a face-to-face basis, are people that I don't sit with in my office in Arlington, people that I don't sit with here at Avery-Hess. I sit with them, I take them to a ball game, I take them to restaurants, I take them wherever. It's somewhere that's flexible and comfortable for them. It allows the conversation around the financial piece to flow a lot smoother, I've found. So this is what I call the back of the napkin methodology. Some of you have heard me refer to it that way in the past. What this is an affordability exercise. It's also a credibility exercise. So from the affordability standpoint, it's purely looking at what are they paying right now in rent and what are they going to be paying in terms of a housing payment, breaking that down for them as simple as possible, and asking some basic questions to establish the assumptions. I will tell you that this works. This is not, I'm not an infomercial, this is not the proven method, if you will, but I have friends who I've done this for that I'm going to illustrate for you guys in a minute. I know Scott's done some similar exercises to this as well, and it works. So some of the things you need to ask when you do a back of a napkin in a social setting, the idea is that in this situation you don't need overly fancy analytical calculators. We're not going to talk about inflation and property appreciation rates. We're not going to talk about discount rates and opportunity cost of taking your down payment and using it and putting it into another investment. I'm not even going to get into that conversation here, because all I'm looking to do is an affordability analysis. Does this make sense on a monthly basis from an affordability standpoint? So these are the key questions that I ask. You have to, if you don't memorize these questions and you don't memorize the assumptions that I'm going to put on the next page, it's very difficult to do this. But if you have a problem memorizing stuff, stick it in your purse, stick it in your wallet, put it on a small thing. But you got to know you got to be able to ask these questions, and you got to know the assumptions on the next page. So I don't know if somebody that is a lead who I have no established relationship with right off the bat, I don't know if I'd approach it with that. It's a good question. That's an important question to ask. I'm just not sure if I'd lead with that, because ultimately their intention at that point is, I've located a property that because you said, there's a property they want to see, it's $3,000 a month in rent. I'm going to do I'm not a real estate agent, so I'm going to put my realtor hat on for 2 seconds. I would feel like I'd want to do my job and show them that house. But now you've established that in person, you've had a conversation, you've served. Exactly. Perfect. Perfect.
This is only 1,500 square feet.
Yeah.
So you've got to get a conversation started.
So I think the way I would approach it is, okay, let's say they want to see 2 or 3 properties and they're priced at 26, 28, 3,000, whatever, and you already know ahead of time. The nice thing is you know ahead of time where those properties are, so you have an idea of a comparable sale in terms of that neighborhood, what it goes for. So then it's about, I would show them the properties, but then say, hey, do you mind if, chances are somebody who's paying $2,600, $2,800, $3,000, your jobs are not to do mortgage pre-approvals, but usually somebody that's looking around $3,000 a month in rent has a pretty good chance at being able to qualify for a loan. Not everybody. These are the 5 assumptions that need to be made in terms of how you do this, and I'm doing this without any fancy calculators. Why does that look cool? Because it builds credibility that you know how to make these assumptions and you understand basic finances. If you start whipping out calculators, it scares the crap out of these people, so don't do that. Principal and interest payment, we're going to work with a $500 per month assumption on $100K borrowed. So for every $100,000 that they need to borrow on a mortgage, we're going to assume $500 in principal and interest. Annual property taxes, about 1% of the sales price. I understand it can be a little lower, a little higher, but we're just using that as approximation for now. Homeowners insurance is about $15 per month for every 100K in the sales price. Once again, can be a little higher or lower depending on what you're buying. And then we need to factor in HOA or condo. If they answer that question, what kind of home are you looking to buy? HOA or condo. And then we need to factor in the tax benefits. So once again, I'm going to use a 30% tax rate. There are cases to be made to use higher, but I'm going to use 30% for the purposes of my example. Any questions on these assumptions before I dive into our little bit of role play here? Perfect. All right, so Christina is going to play my renter. Christina, I understand that you're possibly thinking about buying a home.
I am.
Tell me how much you are currently paying in rent right now.
I pay $2,100.
Okay, so Christina is paying $2,100 in rent. And where do you currently live?
Alexandria.
Alexandria, okay. And what type of housing situation are you in right now?
I'm in a 2-bedroom.
2-bedroom apartment or?
Apartment.
Okay, 2-bedroom apartment, great. And if you were thinking about, if you could buy a house, can you give me an idea of what area you might be interested in buying in and what type of house, condo, maybe a townhouse, maybe a single family, what would suit your needs?
I work in Springfield, so
Okay.
obviously I like to be a little bit closer to work.
Okay,
I'm definitely not interested in a condo because I don't want to waste my money on those condo fees.
okay.
So probably townhouse.
All right, so we'll say townhouse. And in terms of down payment, do you have any funds you've set aside that you could use for a purchase, or what are you thinking there?
I do. I have saved for a little bit. I have about 10 to 15,000.
Okay,
Ideally, I'd like to not use that. I also have retirement as well.
okay, so some of that's retirement, some of it's,
Some of it's
checking, savings,
Correct.
things. Okay, got it. And income-wise, can you give me an idea of household income right now and what you?
About 85,000.
About 85,000. Okay. Great. All right. So I know if you're trying to stay in the Springfield area, and I'm going to time out. I'm going to put my realtor hat on here. I'm not a realtor, but I know Springfield townhouse prices run upper 3s to mid 4s. Somewhere in there, you can find something reasonable. All right. Time in. So Christina. Exactly. So Christina, I know, in Springfield, if you're looking for a 3-bed, maybe 2.5 bath townhouses, prices are roughly upper 3s to mid 4s based on what's currently on the market. So for the purposes of this exercise, I'm going to assume a $420,000 sales price. So that's what we would be working with in terms of a house that you might be interested in buying. You mentioned you don't have much for the down payment, and that's okay because in Virginia right now there's a program that's being utilized through the Virginia Housing Development Authority. It's VHDA. VHDA is our state housing finance agency, and what they're able to help you do is give you some grant money to help cover that down payment so that you don't have to tap in to this money right here to be able to cover your down payment. So let's assume in this scenario, if they were able to give you a grant for 3% for the down payment, you would have to finance the other 97%. So roughly, once again, just going to use some rough figures for this analysis, 97% of 420 is right around 400K in terms of how much you would need to borrow. Fair enough?
Okay.
Any questions so far?
No.
Okay. So the next thing we need to do is figure out, based on this 400K mortgage, what does your monthly payment look like? Because we need to be able to compare this amount right here with what you're going to be paying on a monthly basis if you were to decide to buy a townhouse in Springfield at $420,000. So let's figure out what the different components are of this monthly payment. All right, so the first component, and it's the biggest, is the principal and interest component of the mortgage payment. This is the repayment. This is the amount that you've promised to pay back, $400,000. This is the way that you pay it back. The way that we calculate principal and interest, roughly, is it usually is about $500 for every $100,000 that you borrow right here. So if we say $500 times 4, because 400,000, that gives me a principal and interest payment of roughly $2,000 a month. That's obviously the biggest part of the payment each month, okay? Any questions on that? Nope. All right, so then there's 3 other aspects of your monthly payment that we need to talk about. The first part of your payment is your property taxes. The second part, I should say, is your property taxes. So property taxes, typically about 1% of the sales price in Fairfax County. So if you're buying this house for $420,000, 1% of that is $4,200 a year. If we break that down on a monthly basis, it's about $350 a month. So take 4,200, I'm gonna divide that by 12, and that equals $350 a month, okay? HOI is an abbreviation for homeowners insurance. So anytime you buy a house, you got to get a homeowners insurance policy. That's going to protect you against any type of catastrophic events or failures that happen in the house. You need to have homeowners insurance because the mortgage company that's going to lend you this $400,000 is going to require it. Okay. Typically, homeowners insurance premiums run about $15 per month for every $100,000 that's in the sales price. So if you're buying for $420, it's going to be somewhere around $60 a month in terms of your homeowners insurance premium. Okay, so we take 15 times 4, and that's going to equal $60 a month. All right. The last thing is an HOA. So if you choose to buy a townhouse, there's going to be some HOA dues involved with the purchase. HOA dues on a townhouse typically run anywhere from $60 to $100 a month, and these go towards paying the trash company to pick up the trash, the landscapers, the lawnmowers, everything that has to happen in terms of maintaining the property grounds and the homes in the HOA. So if it's $60 to $80 a month, for our assumption, I'm just going to take the middle of that amount and say it's roughly $80 a month. And now I'm going to get a new marker. Ugh. All right, that's better. So this is what establishes our monthly payment. In terms of principal and interest, we have taxes, we have homeowners insurance, and we have HOA. So you need to add all of that up. So we have $2,350 is $2,350 plus 60 is $2,410 plus 80 is $2,490. So purely from an out-of-pocket cash flow standpoint, in terms of how much you would need to pay on a $420,000 house with 3% down, of which VHCA is going to help you with that, you're looking at a payment of about $2,490 a month as compared to this payment right here. How does that sound so far? A little scary, right? Yeah, I mean, you're talking almost $400 more per month than your current rental situation. It's nice that you're getting to move into a townhouse, which is a little bit bigger than the apartment, but purely from the cash flow standpoint, yeah, a little bit intimidating.
You'll hear this, but Greg, I only take home $3,000 a month.
Exactly.
You'll hear him voice it that way.
Sure. So, so the good news, Christina, is that when you're paying that $2,100 in rent every month, you don't get any help from Uncle Sam out of paying $2,100 a month. You just pocket that, or that goes to your landlord's pocket, and you don't get any tax benefit. But I have some good news for you, in that this payment of $2,490, there is some tax savings hidden in this payment. And so what we need to do is spend a couple of minutes figuring out what that tax savings looks like. There's two ways that you benefit from a tax standpoint when you pay a mortgage every month, okay? The first is through interest, and the other is through property taxes, okay? So what we need to do is figure out, what are those amounts? How much are you paying on an annual basis to give us an idea of what your tax deduction is? Tax deduction is basically saying, okay, if you make $85,000 a year in income, right now the IRS, for simple purposes, is saying, all right, we're going to tax you on that entire $85,000 in income as somebody who's currently renting. However, if you decide to buy this townhouse, these two amounts right here on an annualized basis are going to come off of this amount. So instead of getting taxed at $85,000, you may only get taxed at $65,000. That's what generates the tax savings. So there's a tax deduction, that's what generates the tax savings. That's ultimately what puts more money back in your pocket. So here's what we need to do. We need to figure out first is our interest component. And so I know approximately, once again, this is approximate, that 75% of this payment accounts for interest. Oh, these markers are not helping me out. And then 25% accounts for principal, okay? The principal is the amount that you're paying back on the loan. So every single month you watch this amount drop because you're dropping principal into that payment each month. The interest is the amount that you're paying to borrow it. And the good news is this is the amount that's tax deductible. So I know simple math tells me that 75% of $2,000 is $1,500 a month. If I were to annualize that amount, that comes out to $18,000 a year in terms of a tax deduction that you do not have right now because you're renting a 2-bedroom apartment in Alexandria. Remember, I also said that property taxes are tax deductible, so I know that I can add $4,200 to this amount, and I can give you a tax deduction that's almost $22K per year. So I can take your $85K in taxable income and say, you know what? Now the IRS is only going to be able to touch $63,000 of that money, once again creating the tax savings. In order to figure out how this tax savings has an impact on this payment, we need to look at this amount in terms of your tax rate. So right now you're paying about you're making about $85,000 a year in income. I know that that's right at about a 25% federal income tax rate. You're also paying about another 6% to Virginia. So I'll tell you that I think in total you're paying about 30% of your income right now to the IRS and to the state of Virginia. So what we need to do is take this number right here and multiply it by 30% to show what your tax savings are on a monthly basis. So I know 22,000 times 30%, time out. So if you struggle with calculators in terms, oh yes, thank gosh.
It's not a big one.
That's okay.
It's a Sharpie.
Thank you. Thank you. Perfect. So for people who aren't math majors, this is one of the harder numbers. 22,000 times 30%. Just take 10% of 22,000. That's $2,200, right? Multiply it by 3. So that's how you get your $6,600. Woohoo! This market loves me. All right, so $6,600 a year. That's what you are going to pocket because you just decided to buy a townhouse in Springfield instead of continuing to rent in Alexandria. This amount on a monthly basis is $550. So when I look at the savings, I take $2,490 and I subtract $550, and that's going to give you what your payment is in terms of what you make after what it is after we realize tax savings, which is $1,940. So now, remember how you didn't feel so good about this payment right here because it's $400 more than this payment? How do you feel about that payment?
Feel great.
Feeling better? Okay. What if I told you I could get it even lower than that?
That'd be amazing.
Really? Okay. So I'm going to teach you about something called mortgage credit certificates. Are you familiar with what a mortgage credit certificate is? All right. So VHCA has something called MCCs. What it is a tax credit. So it's a tax credit instead of a tax deduction. And what the MCC allows is for 80% or 20% of your interest deduction to serve as a tax credit instead of a deduction. So let me show you how that paints the picture in terms of what we just went over.
Okay, for you accountants out there, let me tell you something. A tax credit
I'll explain in a second. I'm going to get there.
is, yeah,
It's big money.
big money
So,
versus a tax deduction.
20% of what, can you say that?
So, yep. So basically what the MCC is it says that of the interest that you pay on an annualized basis, 20% of it is going to be a tax credit. The other 80% of it is going to be a tax deduction. Okay? This is obviously, these MCCs are available through, if you get a VHCA loan, they're also available if you don't get a VHCA loan. I'll get into more of that later when we talk about down payment assistance and all that stuff. But for now, I'm working with Christina on how we're going to work this out. So how we're going to save her some more money. So 20%, I know right off the bat, that's going to be a tax credit. So $3,600 a year becomes a tax credit. We still have our tax deduction over here, which is $15,400 plus our $4,200 in taxes, because remember that doesn't go away. We still got the 80% in the taxes. So I'm going to say this is roughly $19K in deductions, and then we have $3,600 in credit. So we're going to do the same exact math, Christina, that we did before and say, all right, what if we add this to 30% of this amount? Because remember, that's your tax rate that we used before to figure out your tax savings, okay? So 30% of 19 is, I think, roughly 5,800 if I did the stupid math correct. 57, sorry. So 5,700 in terms of tax savings over here because you're taking the deductions, and then you have $3,600 in your tax credit. So remember before we said that we were going to save you $6,600 a year in taxes because we deducted these two amounts. Now I'm going to save you 57 plus 36. What is that for all the math majors in the room? $9,300 a year. Divide that by 12, and I think it's $775. Sorry for the crooked writing, but at the end of the day, I'm trying to go fast. So $775. So let's go back to our previous page and I've used 2 napkins here. I apologize. So I'm taking, exactly, they're perfect. And so instead of deducting this by $550, I'm going to deduct it by $775. What is that payment real quick? It's $1,715. All right, Christina, so let's look at $1,715 versus $2,100. Now, how do you feel about that payment?
I feel a new car coming on.
New car coming on. Well, it's funny you mentioned that, Christina, because remember we were talking earlier about how, there was this struggle of, student loan debt, and it was just making it harder to pay that down. Do you feel like this would be a good way to help knock out some of that debt because we just opened up a little bit more money for you to be able to pay that loan down?
Absolutely.
Yeah, I agree. So, guys, that's how we do it. Anybody have any questions about this?
God bless America. Uncle Sam is your partner.
Uncle Sam is your partner. So that's the keys here. That's the conversational piece in terms of how that works. The only way you can do this and obviously look like you're a credible source is to be able to use 2 napkins. But you got to practice. You got to work at this. This is not something that. Did you have a question?
Yeah, I do.
Yeah, sure.
Who does the calculation? Is that your accountant doing that at the tax end of the year?
For
Tax credit as well as?
Yeah, the MC, right, exactly. So when you file, you will get a certificate from VHDA for that MCC, which says 20% of your interest is now a tax credit versus the 80%.
That's not on every loan.
So you can combo.
So you want to be, it's not on every loan.
So we're going to get into the income caps here in a second. You can do an MCC on a non-VHDA loan. A lot of people don't realize that. So you can do that. You just have to get approval from VHDA to get that MCC. It's income capped, just like VHDA is. So I think it's $121,000 for 2-person household and $143,000 for 3. Now, on the other hand, we're doing the down payment assistance here. So we're jumping ahead a little bit, but that's okay. So the down payment assistance, you're going to be capped at VHDA at about $97,000 for a 2-person household and $113,000 for a 3 or more. The MCC goes up to 100% of the median income limits for this area, which I think encompasses all the offices where Avery-Hess is. If you get out to the really far boonies, then those income amounts drop. What's that? It's for as long as you remain in the house as a primary residence. So if you move on, that MCC goes away. Yes, but I go back. I'm going to connect the dots for everybody. Remember the statistic I told you about the median time that millennials plan on living in the house? Who remembers how long that was? 10 years. So that's a lot of money. You compare the $9,300 versus the $6,600, it's $2,700 a year times 5 years, 10 years. It's a lot of money. Go ahead.
How would you get over the objection where they're going to say, okay, I see the tax credit, but the monthly payment is still higher than what it was before when I was renting?
I'm glad you asked that question.
Who wants to handle it? Do you want me to handle it or?
I'm glad you asked that question.
Yes, absolutely. So the way that you get over.
Because that's exactly what you get at that
Absolutely.
point in time. I only take
Yeah.
home so much money, and oh my God, I still got to make $2,500, whatever it is, Greg, $2,500 a month payment.
Yeah, absolutely. So
And
the
I'm only paying
So here's the deal. I can give you this tax savings as a lump sum at the end of the year when you file your taxes, or I can give it to you monthly or in the terms of your paycheck biweekly or semi-monthly. How would you prefer it? Would you rather have it in your paycheck? Absolutely. So all you got to do is run over to your HR department on day 1 after you buy the house and ask them for this little form called a W-4 form. They will help you fill that out. And there's actually a calculator on the IRS website that will go, and I can go through that with them, or you can go through that with them, that will allow them to figure out how many exemptions they need to take in order to get more money back in each paycheck on a biweekly or semi-monthly basis so that they can afford to make this payment but still get all the tax savings that we just talked about here. So in this area, most counties in Northern Virginia, Arlington, Alexandria, Fairfax, Prince William, Loudoun, VHDA, the median income amount for a 1 or 2 person household is about $121,000, and then for a 3+, it's about $143,000, $144,000, something like that. So as long as the household size is correct, they're buying the house, primary residence, they meet VHDA's requirements around either have to be a first-time buyer or not have lived and owned a primary residence in the last 3 years. As long as you check all the boxes with VHDA and you're under the income amount, you can get an MCC. You can get an additional tax credit for paying your interest. Instead of all the interest being deductible, portion of it's tax credit, portion of it's deductible. Does that, what did I miss? So that's all specific to the, MCC has nothing to do with underwriting qualifications. So that's all specific to a conventional loan or an FHA loan or what they want. With VHDA's programs, FHA's minimum 620 and conventional 660. So
660.
yeah, for their conventional Fannie no MI product. So yeah, so it's a great tool that we can utilize for clients. Okay, so that's the more affordability exercise. This is the credibility exercise, but you're going to get those clients to say, Greg, what if I only want to stay in the house for 2 years? Greg, what happens if I need to move overseas? Greg, what happens if something might change? What happens if the market tanks? What happens if property values don't go up? What happens if property values do go up? What does that mean in terms of the investment decision that I'm about to make in terms of buying a home? So what we want to do is give you guys, we've scoured the internet and various sources for a really dynamic, good rent versus buy tool that you can provide to your clients. Because what did I say about millennials before? They like videos and they like links that add value. So we're going to provide you guys with a tool that we think could add value. And Christina, I'm going to sit down. You guys have heard me talk for too long.